Good evening, ladies and gentlemen, and welcome to the CIGI Global Policy Forum. The Policy Forum is an exclusive, by invitation only, series of briefings on global affairs that are current and topical, and of course we welcome a dialogue and a discussion at the end of the presentation. CIGI is the Centre for International Governance Innovation, based in Waterloo, with a network of fellows and partnerships around the world, and we are focused on international governance. Tonight, to introduce our speaker more properly, I'd like to invite Domenico Lombardi, the Director of the Global Economy Program at CIGI, to say a few words about Susan Schadler.
Thank you very much, Fred. So just before introducing Susan, I'd like to say a couple of words on what we are doing in the Global Economy Program, and by doing so, I will introduce Susan and also give you a little bit of context about the paper that she will be presenting to us tonight. So first of all, in terms of the approach we follow, it's all about our scholars, and I think Susan's bio very well exemplifies how strong is our senior scholars roster. Susan, of course, spent almost an entire career at the IMF. She was, in the end, she was deputy director of the European Department of the IMF. She signed off on surveillance reports on Turkey, the United Kingdom, many of Central and Eastern European countries, and maybe there are some other countries I'm forgetting, Susan, so I'm speaking under your control. Then a couple of words about the topic, and this will allow me to introduce a little bit the context for Susan's paper. First of all, we try to pick topics that allow CIGI and the Global Economy Program to position itself authoritatively and preemptively on major policy issues. And just to give you an example, a year ago, we had, it all started in Canada, in Waterloo, and we had a small but very focused meeting discussing a very early draft of the paper that Susan is going to explain to us tonight. And then as Susan was finalizing the draft, she gave presentations at the Council of Councils, at the Brussels-based think tank Bruegel, at the Italian Senate, and this engagement tour culminated a couple of weeks ago with a presentation, a seminar that she gave before the IMF Executive Board, and the Financial Times the following day reported on that, and it's in the folder that you can pick up at the reception desk. And it ends, if I may say so, in Canada, again in Ottawa, and Susan will be presenting her assessment of the IMF lending framework. And Susan, so I would give you the floor, and thank you very much.
Good evening. Thanks very much for coming, and thanks, Domenico, for that very nice introduction. It's a pleasure to work with CIGI on this because there's a huge amount of expertise and enthusiasm, and it just seems to fit very nicely with my own personal views. Well, sovereign debt crises, they always excite a lot of passion, almost always after a serious sovereign debt crisis or a batch of serious sovereign debt crises, as we've been through recently. There are pleas for fixing the faults in the system that prevented as effective a resolution of the crisis as there should have been. The euro crisis is no exception. So we're now in a period of debate, and the question is this debate going to lead to any steps toward a better system for dealing with sovereign debt crises, or is it really going to all collapse in a sort of collective shrug? There are two constraints that this kind of debate that we're starting to see now almost always encounter. The first is that as the debate on the merits of various schemes to fix the problem takes place, major financial institutions come out punching. Their case is that any action to move away from the current absence of a system, what they like to call the market-based case-by-case approach, would destabilize financial markets. And true to form, a couple of weeks ago, the Institute for International Finance came out with a paper that is the reflections of a working group they formed, which came down pretty hard on just about every idea that is out there being debated right now. A second constant in these debates is that efforts to bring some sort of anchor into the system fail to find a country or a group of countries that is, in a sense, willing to pick up the mantle and lead the charge. Basically, enthusiasm gets sapped by two kinds of choruses that you hear. The first is, well, there are a lot of vulnerable countries out there right now, and if we start talking about anything that scares investors, we're going to find we have a whole bunch of new sovereign debt crises on our hands that resulted from our discussion of the options for dealing with them. So that's what you hear right now. I mean, look around, there's South Africa, there's Turkey, there's India, Indonesia. If we start talking seriously about a way of dealing more rationally with sovereign debt crises, we're going to stir up a lot of market turmoil in those places. And then the other side of this is, well, when times are really calm, take 2004 to 2006, when everyone said this is the Great Moderation, why do we have to go through some really wrenching discussion of how to handle sovereign debt crises when there really aren't even any on the horizon? So let's not do it now. There will be a better time when the problem seems more urgent. So there's sort of no time when this is a good issue. And that really stymies debate. Now, my premise is simply that the experience with Greece and Ireland and Portugal by extension, but I think Greece is the sort of clearest example of what can go wrong. That the way that the global financial system dealt with Greece essentially took away even the limited anchor that the system had for dealing with countries and has left something of a even worse non-system that needs to be fixed. Now, handling sovereign debt crises and the debate about how to do it involves many elements. There is firstly the element of judging when the IMF should be bailing out private creditors. There are obviously questions around setting policies that a severely indebted country needs to follow in order to bring its economy back. There are many questions surrounding arrangements for restructuring, reprofiling, having a standstill, however you want to call it, should the country need it. And there are questions about how the fund handles a country that might be in arrears to its private creditors. It's in the fund jargon, it's called lending into arrears. And this is formally prohibited within the fund, although the fund has come to terms with the fact that at times it does need to lend into arrears. So there are many, many facets of this big problem of how to create a rational system for taking care of a severely indebted sovereign country. I'm going to just talk about the first of these. The piece that I really took on was when and how does the fund decide that it should bail out private creditors? This is not to say that if you solved this problem, if you got an answer to that question, you would have solved the problem, but it's one important part that needs to be addressed, at least concomitantly with the other parts. Now, the starting point of this talk today is a study that I did with the support of CIGI of the fund's highly controversial decision to lend to Greece in May 2010 to bail out its private creditors. The decision was made to lend by the fund's executive board despite doubts that even with a very strong adjustment program, a program of adjustment and reform, even if it were implemented, and there were many doubts about whether it could and would be, Greece would not have a manageable level of debt over the next 5 to 10 years. So even a really strong program was not going to get Greek debt back to a situation where Greece would be able to manage debt payments on its own. This was, at that point, specifically forbidden. The IMF was not allowed to lend into what in the IMF phraseology is an unsustainable debt situation. So what I did was look at this decision, and I wanted to look at whether there really were some good reasons why the IMF made this decision, good reasons why the IMF changed its framework in order to enable itself to lend, or whether the reasons were bad on both counts. So I spoke to about 30 key policymakers, market participants, IMF staff, IMF management that were in those positions in May 2010 when that decision was made. And my aim was really to understand the considerations behind the positions that all the various players had. Now, what I'm going to do today in talking about the results of this series of interviews is divide my talk into 3 sections. I'm first going to review a little bit of the history just to make you understand where the fund stood in May 2010 in terms of its own institutional arrangements. I'm then going to talk about what happened and where we are after the decision to lend to Greece took place. And then third, I'm going to offer some forward-looking views on things that could be done, where we should go. Okay, back to history. After the Mexico crisis in 1994, the Asia crisis in the late 90s, the Russia crisis in 98, questions arose about whether in these very, very large sovereign debt crises, which were effectively capital account crises, they were not that a country couldn't meet its payments for imports with the amount of money it earned on exports. It was that investors were pulling out of these countries in very, very massive proportions. And lending to the country meant you were bailing out those creditors that wanted to get their money out. So people started saying, I mean, people across the board, people in national governments, people in the IMF, people even in markets started saying, so is this what the IMF is supposed to do? Just bail out private creditors? When they get tired of a country, anxious about a country, does the fund just say, okay, you're scot-free, you go, we'll take up the burden? So debate continued for a few years, and in the annual meetings of 2000, which were held in Prague, there was something put together called the Prague Framework. The Prague Framework said, let's look at this problem and let's think about what we think are our real objectives. So they saw 4 reasons, or called attention to 4 reasons, for which the fund should have some constraint on its discretion. First, there was concern about moral hazard. Were investors thinking they would always get bailed out? Most obvious. Second, markets didn't know what the fund was going to do, because the fund said, yeah, we don't just bail out private creditors automatically, but in fact they were. So there was a lot of uncertainty in markets about what the IMF really thought it was doing. And in this debate, it was felt that the IMF should provide some clarity to markets on what its actual intentions were. Third reason for some constraint was to prevent the excessive concentration of IMF resources in one region of the world. Remember that Asia had been a huge crisis, and there had been more lending in Asia than there had ever been in other countries. And so this was a real concentration of the IMF's resources in one region, which is, strictly speaking, not what the IMF was set up to do. And finally, there was concern about preventing undue political influence over the decisions in the IMF. Now, that's a sort of funny term, because the IMF is a political institution. In the end, there are countries with representatives that are never able to disassociate themselves from their own country's national interests. But still, the IMF is, strictly speaking, supposed to be an international organization that has its value added in providing some forum for an objective analysis of how to take care of serious international financial problems. So, at the end of this debate and agreeing on these reasons to try to constrain the fund's discretion, two efforts resulted. The first was the widely publicized sovereign debt restructuring mechanism, which Anne Kruger proposed in the immediate aftermath of the Argentine crisis in 2001. The sovereign debt restructuring mechanism was meant to be a bankruptcy-style court that would allow countries that had such severe debt burdens that they weren't going to be able to repay to go through a systematic process to reschedule the debts. This was, of course, shot down, got some support initially, but ultimately the Americans went against it, strangely enough, since Anne thought she had the Americans on her side. And it was sort of put in the back cupboard for further review. A much less publicized initiative that came out of the Prague framework was the effort to constrain the IMF's discretion by establishing 4 criteria that borrowing countries had to meet in order to get exceptional access to exceptionally large borrowings from the IMF. So in capital account crises, when investors are fleeing and the fund is clearly bailing out private creditors, 4 criteria had to be met in order for the fund to go ahead. These were agreed in 2003, put into effect. Now, the 4 criteria, obviously there's legal language and they're very precisely stated. But roughly speaking, they are, first, that the country has to have a very large balance of payments need. Second, and I think most critically, this is the backbone of the 4 criteria, a rigorous analysis of a country's debt sustainability profile shows a high probability that the country will have a sustainable level of debt over the medium term. So in other words, all the program, everything that goes into the new path for the country is going to put it into a position where it has a sustainable level of debt. It can service its debt without access to IMF resources or any other exceptional resources. Third, and this is kind of a reinforcement of the second criterion, in fact, it is a reinforcement of the second criterion. At the end of the fund program, the country will be able to go back and access private markets. So the country will have access to private financing at the end of the IMF program. This is another way of saying its debt will be sustainable. And fourth, the policy program that the country's put together provides a reasonably strong prospect of success. The country will implement it, and if it implements it, it will get the country back on the track. Now, I was at the fund when the 4 criteria were put in place, but I was absolutely not involved. And I actually didn't know too much about the 4 criteria because I was in the European department and we didn't think that crises ever really happened in Europe. So I have no stake in these personally, but I have to tell you, upon thinking further over the past year or two about them, I think they're excellent public policy. I mean, I can't think of a better way to approach the problem than the 4 criteria. There is no appeal to this arbitrary quota. In other words, you know, the fund used to work on quotas. You could only borrow X% of your quota. Well, clearly when the crisis is huge, if you think you can help a country and the country can get back on its feet, you could lend any amount of money as long as you're pretty sure that it's going to get the country back into business. The criteria do not appeal to a solvency illiquidity distinction, which I think is never accurate in the case of a country. Basically, there is a crisis where a country is not willing or able to repay no matter what happens, and that's the set of situations in which you shouldn't be lending unless you think the country has a reasonable prospect of getting over that. And third, these 4 criteria, they actually take about 20 lines. They're very parsimonious. They're very basic. And they say, here are the 4 basic considerations that we need to take into account. They're not complicated. They're easy to understand. They're So the four criteria put into effect, pretty smooth sailing. First of all, you had this period of the great moderation when nobody borrowed from the fund, so obviously that wasn't much of a test. But even in 2008-9, there were cases that came to the fund for exceptional access, and the countries broadly met the four criteria, and they worked pretty well. Then came Greece. And it was clear when the fund staff did their debt sustainability analysis that they could not say there was a high probability that Greece, even with a very strong adjustment program, which it was questionable whether they would be able to implement, even with that, the fund staff said, we can't vouch for the high probability. So there was a lot of debate within the fund about how to fudge this thing, and finally the solution was to change the second of the four criteria, the debt sustainability criterion, the one that I personally regard as the backbone of the four criteria. So the change was to introduce what's called a systemic risk waiver. It says that if a country is, if the crisis in a country is likely to have serious adverse systemic spillover risks, the country does not have to meet the debt sustainability criterion. With that change to the second criterion, the Greek program went ahead. Now, the really interesting thing about that change was that it was made in the context of the board meeting for approving the loan to Greece. Well, this is totally contrary to any precedent you could find in fund policy, where fund policies, there are papers, there are debates, there are more papers, more debates, and finally, after years, fund policies get changed. This was changed in the course of one board meeting, and many executive directors that I spoke to said, we felt cornered. This was a dire emergency. We had the Greek program to approve and a change in fund policy to approve, and it was really, it was a very no-win situation for executive directors who were worried about it. You might have seen recently the minutes of that board meeting they're secret, but they were published by the Wall Street Journal a couple of months back, and you can see just how serious some of the executive directors took this proposition of changing the rules of the fund in the context of approving the Greek program. And these were, the staff made clear, permanent changes. This wasn't a change just to allow the fund to lend to Greece, but it was a change that would apply for all countries in the future. So where do things stand now? Arguably, I would say pretty much where they were in 2002. There is no SDRM. That whole debate resulted in no change. Too many very strong opposing forces to it. But there was a step forward in the sense that the decision was made to encourage countries that were borrowing on international markets to include collective action clauses in their bonds, which makes it easier to reach agreement among creditors to reschedule if that becomes necessary. So it was an improvement, although collective action clauses, CACs as they're called, definitely are recognized as not being the answer to the problem of rescheduling. They just help. There have been several successful restructurings. Obviously, Argentina is the big exception. But in the period since 2002 and the implementation of CACs and bond contracts, there have been at least a dozen, I'd say, successful restructurings. So it has, in a sense, been a vindication for the people who say, yeah, leave it to markets and somehow they'll figure things out. The systemic risk waiver is permanent, so that is now a fact of life. It is enshrined in fund policy at the moment. So what does that mean? Well, it means, first of all, any country that has the risk of causing systemic spillover effects is going to be exempt from the debt sustainability criterion. Well, if you think about it, any crisis that's serious enough to warrant exceptional access to fund resources, in other words, really big access, it's very unlikely that that country is not going to have some sort of systemic spillover effect, no matter what it does. So this is another way of saying, if you're a country that's bigger than Grenada, you're not going to have to pass the sustainability test, because we can always say that you are likely to cause systemic spillover effects if we don't lend to you. It even makes more of a mockery of the third criterion, which is saying that the fund staff believe that the country will have access to private markets by the end of the fund program. Because obviously, if you don't have sustainable debt, it's very unlikely that private markets are going to want to lend to you. So in fact, they've kind of undermined 2 of the 4 criteria by changing the 1. And this really, I think, does serious damage to the internal consistency of the 4 criteria. The 4 criteria kind of build one upon another, and by taking out one of the blocks, you kind of, the whole structure crumbles. It definitely leaves the IMF prey to political influences, which it was in Greece, and I think in a highly precedent-conscious institution, this precedent is a very important one. It leaves the market to guess what the fund is going to do in future debt crises. The market, the market looks at the past to judge the future. And in fact, in my interviews, one thing that I ask every single person I spoke to is, let's think about this scenario. 25 years from now, somehow the Greek crisis has resolved itself and Europe is back on its feet. We're not worried about Europe anymore. We even kind of forget there was a European debt crisis. Vietnam has a crisis, serious crisis, small country, but still serious crisis. A lot of Chinese banks lending to this government and private sector in Vietnam. And Vietnam comes to the fund and says, we need a bailout. And the fund says, oh, well, you don't have debt sustainability. Well, the first thing that China's going to do is go to the fund and say, hang on a second, remember, Europe, don't you think we should get the same treatment? So I asked everyone, what do you think is going to happen in this situation? So the Europeans, to a person, said, the precedent has no relevance. This is a currency union. It's completely different. Europe will always be seen as an exception. It's not like other countries. In the United States, people said, oh, good question. Yeah, I don't know. And when I asked markets, they said, well, we know completely what will happen. The IMF will bail us out. So it just seemed to me that where things stand now was pretty much summarized by those 3 reactions. Let me talk a little bit about where things should or could go from here. First, I think it's important to realize, and it's hard to realize, hard to really understand, that there's a basic precept in all of the sovereign debt restructuring issues that come up, which is that any framework for handling sovereign debt crises has to deal with the fact that there is no on-off switch. There is not, this country is okay and we can lend to it, and this country is not okay and we can't lend to it. There just aren't black and white answers. It's all about probabilities. And this makes a lot of people really uneasy. So you say, for example, the second criterion was that the country had to have a high probability of debt sustainability. Well, people want to interpret that as, well, the fund staff says there will be debt sustainability, or the fund staff says there won't. It's not what the fund staff's saying. The fund staff says, it's nothing so absolute. The fund staff says, we think the probability is high. It's not 100%, but it's high. Then everyone says, well, that's so subjective. How do you deal with that? And I think the way that should get dealt with is understanding that you can even give the benefit of the doubt to heavily indebted countries that look like they've got a program. It's not 100%, but looks like has a good shot at making it. Greece didn't pass that test. At the time, I was writing a blog for the Atlantic Council on the Greek program, May 2010. So I did a lot of work and looking around at what people were saying. To a person outside the fund, they said this is never going to work. There's either going to be restructuring or Europe's going to have to bail out Greece. But it was beyond the high probability mark. So the high probability gives a lot of scope for discretion, for not being excessively harsh, for not calling for restructurings when they're not really necessary. But it's important to realize that we're dealing with probabilities. And when you're dealing with probabilities, you need experts who say, we pass the probability test or we don't. And that's why we have the IMF, because the IMF staff is really good at doing this. There's a huge amount of expertise on dealing with debt crises, on experience with dealing with debt crises. And while they're not perfect, they actually are as good as you're going to get, at least in my view, at determining when you reach this high probability mark. Now, the environment we're dealing with right now is a difficult one. When I was talking to people, I think there were 3 broad takes on what's going on and what's going to happen. First of all, there's a lot of discussion out there that the IMF staff, everyone knows, is working on a paper. The IMF staff produced a paper last April in which they basically took stock of where the framework for sovereign debt crises stands at the moment. And it was greeted, I'd say, semi-enthusiastically by the executive board, who said, yeah, go back and do some more work on it, and we'll think about it again later. So they're now in the process of preparing another set of papers, in fact. I think it remains to be seen whether they actually get out into the open or not, but that's another question. The scuttlebutt is that the IMF has a plan for a mandatory standstill whenever a large program is initiated. To me, this is very harsh and automatic. It says if a big country, take Vietnam in 25 years, comes to the fund will say, you need to have a standstill right now. And that might be appropriate, but it might not be appropriate, because it might be that, as in many countries in the past 12, 15 years, the country actually can get itself back together again, even though it's in a pretty dire situation at the moment. So there's a lot of discussions, a lot of speculation about exactly what the IMF staff is doing, but this seems to be the direction in which they probably are headed. There's another whole set of people out there who are saying this is all just talk. The fund can do nothing because basically Europe doesn't want this question discussed while there is any danger to their banking system, to large sovereign debtors, and they're going to shut this discussion down right away. So it's fine that the fund staff is preparing this paper, but basically it's not going anywhere. It's dead in the water. Then I think outside of the fund, there's also kind of a looking around to try to figure out who is going to lead the charge, if there were a charge on this issue. You will have seen, well, you can see if you want, the minutes that were put together by that were published by the Wall Street Journal. And there were clearly several countries that were very, very disturbed by the Greek board meeting. Of course, talk is cheap, so it might be that they expressed more reservations in the board meeting than they really felt. But still, there were strong words spoken there. And I would say Canada was among them. So there is a sort of nascent or potential group of countries that might be able to get together and say, we really do want to see action. But the group needs a leader, and the group needs some cohesion, because there are a lot of powerful influences that will try to obstruct it. I think that the fund staff's paper in April 2013 was a good start. It put the issues on the table, and it set the framework for more work, more consideration of this issue within the fund down the road. So where would I like to see the process go next? I think there are 2 primary components of what I see as necessary though clearly not entirely sufficient, but necessary start to the process. First, if this spillovers clause is going to stay in the second criterion, this waiver for situations where there are believed to be systemic, international systemic spillover effects from a debt crisis, I think the fund needs to demand that along with the program that appeals to this waiver, there is an analysis of the spillovers. Right now, the fund has never done that. The fund simply says there are spillover effects, and therefore we don't have to worry about debt sustainability. My question would be, tell me about the spillover effects if, for example, we go ahead with the program bailing out private creditors, or we have a program, but we supplement it with the restructuring. Show me an analysis of the spillover effects in those two situations, and then we can come to some judgment about where the spillover effects are likely to be smallest. Because it is far from clear that the spillover effects from the way the Greek crisis was handled were smaller than they would have been if they had taken on the restructuring immediately in mid-2010. So first requirement is really do the spillovers analysis and make it public, make it clear why these spillovers had to work, were seen in this light rather than in another light. Second essential thing, in my view, is that the membership reconsider the systemic risk waiver and consider going back to the original 4 criteria where, when there's not a high probability of debt sustainability, the IMF says, wait, we will only lend after there's been a restructuring. We'll help the country catalyze new resources, but the only way that's going to work is if there's a restructuring of the overhang of existing debt. So go back to the original 4 criteria. I think there's some other complementary components. I think there is a need for some sort of prescribed procedures for countries where debt is not found to be sustainable. Now, we've gone down the SGRM path, and I think that probably there's not much appetite for reigniting that SGRM debate. I don't think there's a constituency for it. But there are a lot of proposals out there now. The Bank of Canada is working on one with the Bank of England right now for some sort of contingent contract where some sharing of the burden is triggered at the time of a country going to the fund for assistance, or where there is a standstill when the fund deems a country not to have debt with a high sustainable debt with a high probability, where there would be an automatic standstill while a strategy is devised for proceeding. There might even need to be some sort of short-term lending arrangement where you lend for a period of 1, 2, 3 months to ensure that the country meets its obligations and doesn't default in a messy manner, but you stop it after 3 months. Because right now what we have is Greece is still borrowing from the IMF under the systemic risk waiver. Still, the IMF staff says that Greek debt is not sustainable. We're 4 years into this crisis, and this problem should have been resolved by now. And I think the final thing that is really going to be important in this debate is that any action to go ahead is seized by a group of members that would constitute a voice in meaningful steps forward. There needs to be a constituency within the fund, within the G20, within the international community that speaks out in favor of some sort of reform, despite the fact that there is an army of other influential groups that are strongly against. With that, I'll stop and listen to any comments.
There's a microphone here if anyone wants to use it, or feel free to just...
I guess, I don't know if this is on, but 2 things, at least to start. One of the ideas that we had floated in the past was adding some discipline to IMF lending by not implicitly giving them senior creditor status, because legally, of course, they don't have that, but just treating them as a normal creditor so that their money would be put the same risk other lenders' money was. And that would sort of ensure that there's a credible belief in a high probability of success. The other is maybe more fundamental, what you have against standstills. Because if a country sort of has the ability to stop paying its creditors for a time and to negotiate, and it is truly a liquidity problem, it should be possible to reach a solution that helps everyone. And if it turns out to be an insolvency situation, you use the opportunity to restructure. So a little more about the imperfection, the market imperfection in that the IMF's trying to solve. But those two things just to start.
Okay. The senior creditor status, for any of you who don't know a lot about the fund, the IMF has senior creditor status. So whenever it lends to the country, it gets paid back before anyone else, no matter who the other parties are. They are always behind the IMF. As a result, the IMF almost always gets paid back because the country has to be, well, basically incredibly stupid not to pay the IMF back, because once it's not paying the IMF back, no one's going to touch it. So if it even has, a spare $100, they're going to pay the IMF back. And this is not legally binding. It is an understanding. Everyone has played by this rule of the game since the fund began. But there is nothing in any treaty, anything that a member signs on going into the fund that says that the IMF has senior creditor status. So it's a matter of faith. And I can tell you that there have been, since the Greek loan took place, a lot of very nervous people very nervous about whether, in fact, the IMF's senior creditor status is as robust as everybody in the fund hopes that it is. There is, of course, one important precedent, which is when the IMF made very large loans to a lot of very low-income countries during the 1980s, it became apparent that the IMF had lent them way more than they could repay. So forget about those countries borrowing from other sources. It was the IMF that had created that debt problem. And the IMF did ultimately, effectively, write it down. So, but that's sort of treated as, well, yeah, but that was low-income countries, so it's not, serious countries would never do that. I love this issue. It comes up in most talks that I've given on this project that I did. And how can I put this? On a purely intellectual basis, I personally think, well, I certainly think the issue needs to be on the table. I think people need to raise this question and raise it with persistence, say we need to talk about it. Because clearly the IMF is going to be a lot more careful about doing things that effectively stretch a crisis out and don't resolve it if it's at risk of not getting paid back. So I like it. I have to say that here is where my very long career at the IMF stands a little bit in my way, because it is religion in the IMF that the IMF needs to take risks that no one else will take. When a country is down and out, but the IMF staff can see that it has a high probability of making it, the IMF has to be willing to take the risk. And if it gets excessively cautious, because bureaucrats would be very cautious if they didn't have senior creditors, I mean, very cautious, way more cautious than markets would be. If they didn't have senior creditor status, it would, at some level, sort of dry up the fund's purpose. You know what I think? I think that some people who I've talked to who in the past would have said, this is sacrosanct. If the fund doesn't have senior creditor status, it ceases to be a meaningful force in the global financial system, are now saying, Yeah, but if the fund's abusing its senior creditor status by lending into unsustainable situations, then it's time to get back to reality and tell the fund, okay, you need for a while to sit in the seat and really understand the costs of your actions. So I guess I have a lot of sympathy for that view, that if the fund were to do a Greek-style thing again, I would say, the fund is kind of hopeless and probably needs to be disciplined much more severely. So that's it on senior creditor status. I think there are arguments on both sides, but I have to say I think the arguments against changing the senior creditor status are growing weaker. Standstills. I don't have a problem with standstills. I will tell you one story about my views on Greece. My first question, my sort of starting point was, why didn't the fund just say, let's stick by the rules, let's have a standstill in Greece on May 10th, 2010, or earlier. The May 10th was when the program was approved. Greece had a very large amortization payment due on May 18th. And one of the reasons why this whole Greek negotiation was so compressed, which typically they are in serious problems, but one of the reasons in Greece's case was that they needed to get them the money before May 18th. Now, Greece was a special case in this context because it was a currency union. And I came to the conclusion that had I been in the fund on May 9th, 2010, I would have voted for the Greek program for this reason. Had Greece not made that amortization payment, it would have been in default. Standstill, no standstill, it would have been in default. And the ECB was not able to lend to Greece if it was in default. That would have meant that the Greek payment system would have totally collapsed. They had no drachma to put out there. They had no provision for doing anything. And in 1 week, you can't draw it up. Now, you could say, well, the ECB could have changed its rules within 1 week, and it could have enabled itself to lend to Greek banks. I do question that. People at the time said, you don't understand the environment in Europe in that week. It was so fraught that the notion that you were going to have a rational decision made in that week was just beyond belief. So I think I would have said, yeah, get that payment made, and then get these changes made in the ECB that will allow Greece to survive as an economic unit, even when its debt is restructured. And indeed, the ECB did make those changes within a month to 6 weeks of the approval of the program. The ECB had really revolutionized how it was going to deal with Greece. So it was possible at that point to say, okay, stand still, no more payments. Now we have to deal with this. And that's where I think the mistake was made, that sure, maybe in the short term there needed to be a quick disbursement. Maybe it should have come through the BIS instead of the IMF. I mean, there are all sorts of possible ways of thinking about this. But it was this long, long period of denying that there would be a restructuring, and then a restructuring that was insufficient. And then 2014 comes and we're still without debt sustainability. Then I think, okay, this was totally wrong. And then I do believe there should have been a standstill. But to say an automatic standstill, it just seems to me there are cases, things happen where you can't have the standstill the moment of the program always. So that's my really only hesitation. Apart from that, I'd say, yeah, absolutely a standstill. Especially if the fund staff says there isn't a high probability of that sustainability, I have a standstill right away. Why not? I mean, that's the only answer.
Just make one comment and ask one question. My comment has to do with your first question. For Canada, for one, I'm not sure what the accounting treatment is in other countries, but if the IMF is not the senior creditor in these things, then the accounting treatment for Canada of our loans to the IMF and our monies to the IMF is extremely different. And that means that anything that we lend to the IMF then becomes a hit on our fiscal situation, and then there may be no money going to the IMF because Canada would not be in a position. I think it would put the government of Canada in a very difficult situation to fund the IMF if we were not the senior creditor under our own accounting rules. I can't speak for I don't recall the accounting rules of the other countries, but, if the IMF is not a senior creditor, then we got a really big public accounting problem here in Canada.
I'm aware of that.
Yeah, I'm aware of it too. So that's my only comment on that. That's my only comment there. My question, though, is really a kind of sort of political economy question about the IMF and how it operates. And it's particularly relevant, I think, to the Greek situation, which is, my observation of the IMF a little bit is that, for a long time it's been it is an organization that is really dominated by Europe and the United States with a veto. And so, anything that comes to sort of a situation in the backyard of Europe or the front yard of Europe, I don't know where you consider Greece to be, you have an organization that is on the executive board is dominated by Europe. The managing director is always a European. The United States, with its own kind of calculations, has veto power. But at the end of the day, it is a very kind of quasi-Eurocentric institution. And so you can see the bending of the rules and the twisting of the things in an organization that actually is kind of quasi-dominated by Europeans. I guess that's a sort of semi-question, semi-comment, but
Well, I think it's very nice that you said quasi-dominated, because I would have put it even more bluntly than that. I mean, Europe obviously plays an undue influence, and it will change over time. How much does that change the whole IMF? I don't know. Its significance in the global economy is a question, even, because some people would say, yeah, the IMF is really important because Europe really cares about it, and the United States pretty much cares about it. So, yeah, I mean, they bent the rules. The thing, and you could say, okay, well, so what'd you expect? Europe had a crisis, they went to the fund. And first of all, Europe tried not to go to the fund. Trichet was vehemently against taking this whole problem to the fund. And, I think he was right that it would have been way better if Europe had solved the problem on its own. But I also think that Europe was clearly on the wrong track to any sort of solution. And had the fund not been brought in April 2010, things would have been a lot worse than they already were. But I wouldn't just dismiss it and say, yeah, so the fund's European dominated, so they changed this. It has permanent implications for the fund. Not only has it changed the rule forever, permanently, but this is an incredibly precedent-conscious institution. Things get done here because they were done before. And I guarantee you that this hypothetical Vietnamese crisis in 25 years, there's no one who's going to have forgotten the precedent of Europe, not to speak of all the things that will happen between now and then. But it's almost irrelevant. Now Europe has changed the game. I mean, it's no longer being played by the rules that it was before, or at least people thought it was before. And it seems like you should straighten them out. And if it requires saying, look, we blew it with Europe, Greece was a disaster, and we got to straighten things out so that next time we don't, then so be it.
Sorry if I apologize. Can I ask a supplementary then? I mean, my point was not to apologize because it's a European-dominated institution, but to say there's a real problem because it's a European-dominated institution. And that actually, maybe, and we can see this in the resistance to changing the board composition. I think one can make a case that there's a really serious problem, and in some sense you're making the case that there's a really serious problem here with the IMF, because it is a completely dominated European institution with the US veto. And so they make precedential decisions based on their own interest, using an international institution that we all participate in, and there's a real problem there.
Serious problem, yeah.
Can I ask a supplemental?
Of course.
Wasn't the situation made worse in this case because the IMF, the governance situation, the decision was made worse because the IMF was really a junior partner in a team of three, where it was with the ECB, the EC in itself, negotiating with a country when actually all of Europe should have been on the other side of the table talking
definitely.
to. Now, it might not have changed the outcome because, as Michael points out, the IMF is dominated by Europe anyway. But if the IMF, if the Europeans are sitting on your side of the table, and there are two of them, and they've already agreed to something, and you're expected to ante up just part of it, to what extent did that distort or sort of affect things? I mean,
Well, I think, of course, as you say, the IMF is a European-dominated institution, so it's not clear that there would have been much very different happening as a result of the IMF being a really independent force in those negotiations. With Strauss-Kahn as the head of the IMF running for president of France, this was big. But the Troika arrangement, I mean, don't even get me started. That was such a complete set of inconsistencies and impingement on the independence of the IMF that I can't think of anyone who would want to defend it, except possibly some people in the Commission. So yeah, I mean, it's a serious problem. Yeah, well, I think things will probably change because Europe's share ultimately is going to fall. But I mean, you know, who's preventing it right now? Basically, the United States is the one that's standing in the way of that. So that's even more bizarre. I think it's kind of an unintended consequence, but still, it's the United States that's boxing up the works right now. The accounting problem in Canada, I mean, I completely understand that. So here are my two thoughts. First of all, arrangements differ massively across countries. And I suspect that most countries at some level are going to have the same problems that you point to in Canada. But there are countries right now, like the United States, where the contribution to the IMF quota is a budget item. So the United States sees the fund quota as already a fiscal issue. But I'm quite sure if we dug into the arrangements in the United States, we'd find that if the IMF doesn't have senior creditor status, the budget allocation, the amount that has to be allocated for the quota is probably not the same as it is right now with senior creditor status. So I think that's a very important issue. But here's the second point. Right now, the fund used these global resources in a way that, at least arguably, made the crisis more expensive, last longer, and create more uncertainty. And you could ask the question of whether anyone's resources are being spent wisely, whether they're guaranteed or not, if they're being put to that end. So it's sort of, in an accounting sense, I see your point, but if in the end what you're saying is the IMF is going to keep lending until someday someone says, hey, what about the IMF? Why do we have to foot this big bill and the IMF gets off scot-free? And it sort of comes around and bites you from behind. Yeah, I think that's kind of a risk that any government that lets the IMF continue to behave irresponsibly is storing up. I mean, this will probably work out in Greece. I imagine that the Europeans really are going to come up with whatever they need to get Greece through this. But it won't always happen, or it needn't always happen. Someday it might not, and that's the risk that you run.
Thanks for the presentation. Can I just follow up on that last part, though? There's been a bit of a move towards regionalization of these kinds of arrangements. So the European Union is the most obvious and most structured, but Chiang Mai, the Asians are thinking about this kind of stuff. I'm wondering, to the extent that you couched the initial presentation as potentially a problem of the IMF creating inappropriate incentives for private lenders with respect to their dealings with a country. But I'm wondering whether it's just the IMF that's the problem now. In the European case, my suspicion is that a lot of lenders, if they had actually been thinking about this, which clearly they weren't in any meaningful way, but if they'd been thinking about this, they probably would have thought, if Greece goes under, they're probably not thinking IMF, they're probably thinking that the Europeans are going to bail them out. So you still got the same incentive problem of irresponsible incentives for private lenders, but they may not be looking at what's going on at the IMF. They may be looking at this growing tendency for regional collective action in the face of these kinds of crises. So I'm wondering if there's a way that we can deal with that kind of issue.
Yeah, I mean, I think it's a really good question. And I've actually asked that same question in a number of fora where people talk about regional issues. The thing about regional groupings is they cut two ways. On the one hand, regions do tend to stand together and they might put forth a unified front to the IMF. So, take the crisis in Vietnam. Isn't China going to go to bat for Vietnam, and then, they're going to pull Malaysia, Thailand, Indonesia, Singapore, a whole bunch of other countries in and say, look, we need to stand together. We need to make the IMF do this. And I think that's highly probable. I think that this move toward regionalization is definitely going to result in more regional pressure on the IMF coming from many countries in a region to take care of the problems in their region. Of course, Latin America and Africa seem totally unable to come to any kind of regional cooperation agreement, so I think it's kind of not happening there. But in the Middle East, you do see it, where, the Middle East Monetary Fund, and there's the same kind of thing taking place. The difference is between those regional arrangements and Europe is that Europe had a problem because it had a single currency, and those countries actually don't really, it's not going to be popular in China to be bailing out Vietnam. It's just not going to go over well. People are going to say, why don't you send Chinese people? Are going to say, why don't you send Vietnam to the IMF? Why do our tax dollars, yuan, whatever, have to go toward bailing out Vietnam? And so these regional funds are getting established, but it has yet to be tested whether they're going to be very generous with them or whether they're basically going to say, look, we're going to hang on to our resources. You go to the fund first, get your conditionality set up because we're going to have a hard time putting the conditionality together, monitoring the program, and the IMF knows how to do that. We don't. So, and there are definite forces that push regional arrangements to that kind of solution. Get the country to the IMF to really do the hard work. And in the end, that is what happened in Europe. I mean, the Germans, said very clearly to me, why did we want the IMF involved in the end? Because we didn't want to get blamed for all the austerity in Greece. We wanted the IMF to take the blame. And we thought the IMF was going to be able to be tougher than we were going to be on them when they didn't meet the conditions. So, I mean, that will happen in other regional arrangements too. It's just that the other regional arrangements are going to have less incentive to use their own money to try to sort things out because they don't have a common currency. So I think they'll probably put more pressure on the fund regionally than has been exerted perhaps in the past. And I also think that they might be interested in sitting at the table in some capacity, but not too obvious a capacity, because they don't want to look like the taskmasters, and they're fine to let the IMF look like that.
Well, thank you very much, Susan, for joining us today, and thank you as well for the study that you've done. I think, as you can tell, there's a lot of interest in this room and in Canada on this whole issue of sovereign debt restructuring, and some of the contributions that Canada has made in this area goes back even well before the sovereign debt restructuring mechanism that was put forward by Anne. So a great deal of interest. And I think what that really says is a collective view that this is truly an important issue that we haven't yet resolved. And I wasn't quite sure looking forward whether you were optimistic or pessimistic, but I think we're some ways from resolving this current sovereign debt situation in Europe, and you cited other countries that that will be facing from that point of view going forward for sure. So thank you for joining us, but I think as well, thank you for this study with the support of CIGI. I think it is important that this has been brought back onto the policy agenda. I think Europe is far from being resolved from this particular point of view, and so it is critical that you do find leadership, and I think Canada has offered that, and I think with your study and with CIGI's support, this is an area that we can continue to contribute in trying to deal with these sovereign debt issues. So please join me in thanking Susan, and as Fred said, let's continue the discussion afterwards. So thank you very much.